Welcome to a daily stock review of NUTX Inc. Goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey, just 2,500 hours in over the last 7 years. I'm sharing the lessons along the way. This is my investing process. Today I'll cover how I came across this stock and the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while. And by following the breadcrumbs they've left behind, you should be able to follow in their footsteps. If you'd like the free investing resources that I wish I had when I first started, absolutely free. It's a link in the description. It's my gift to you guys. Alright, NUTX. So NUTX is an American company. I came across it. I'm currently looking at small caps, so anything below $2 billion, and with high revenue growth over the last 3 years. What else am I looking for? Out of that pile, I've actually had to go sector to sector. And I'm currently in the health area, so there's a lot of biotechnology companies. And there's a lot of just crap that's not worth looking into in there. About 95% of it is just rubbish. And sometimes you get some businesses that are actually profitable. So if we go back and have a look over the 5-year period, NUTX is at a pretty rough trot. Let's just say it's full of speculation. Back here, it's gone down. It's gone down under $10, so about $6 a share back here in 2024. Now, if you happen to see the trend and have some pretty good insight back here, there was potential that you could have 10x'd over the next 2 years already. And so if we go back even further, we're talking about a share price of 56,000. I don't know what was going on back here, guys. If you were invested back in 2013, 2014, you can tell me about the highs and lows of what they expected this company to do. Anyway, and then we've got this little bump here in about 2022, which is this bump. And then we zoom in, enhance some more into the most recent time, and we get this. So we end up with a PE ratio of 12. So it kind of seems like this is more rational in terms of where it's currently priced. If it's higher revenue, it can mean that investors haven't caught up to the fact that it's actually producing revenue now and it's increasing. And so this business may not be priced appropriately to reflect that growth. And the reasons for that could be that this business has left a wake of burnt shareholders and other people that have been buying into it and have been destroyed by this kind of stuff. Buying during the hype and then 99% loss. And it'd still be pretty close to over a 90% loss by the time it gets over to here. So after it's risen up. So that's how I came across this business. What am I doing? I want to find the annual report. This one was a bit of a tricky one. I then had to go hunt through the SEC's website, grab it out here, and then open her up. All right. So we've got the consolidated statement of operations. So I like looking at the income statement first. The first thing that can flow into the business, I guess this is top down. Look at the financials is money comes in. Bottom line is cash out of the business. And so what can I see here? Ooh-wee. So we've got, it's in thousands. So we've got 218 million. 449 million, 844 million in the hospital division. Ooh. These guys are making bank. So that's a double and then a double again. That's pretty crazy. So let's have a look and see what that translates to in gross profits. So we've got payroll, contract, medical, depreciation, amortization, total operating costs and expenses. You can see that that's gone up as well. And back here, pretty much the gross profit was nothing. Most of that was chewed out by all those operating costs and expenses. We can see now that the business is really starting to translate. That total revenue is now popping out in this gross profit. Where is the main growth for this been? So contract services has doubled in the last year, and payroll's gone up. Not the same amount, not a double, but it's gone up a bit. So that's good to see that those profit margins have increased. Now these contract services, you can see that contract services has taken over payroll. So like, I haven't looked at this business at all. This is the first sticky beak at it. And so it's interesting to note that the contract services part is taking over payroll, whether this be people, specialized knowledge and things like that, and then grabbing out to contract services for that, or whether it be just other parts that they're providing services on. Alrighty. What else we got? Stock-based compensation's gone up. That's alright for the time being. Income, so they did make a loss back in those years of 2023. More than a double back up into operating income. Let's just go for the net figure. So 43 million loss, back to a 94 million profit, and then doubled that to 180 million net income. So this business makes 180 million net, and maybe there's potential that this growth rate, the business hasn't been reflected by shareholders, because a usual kind of PE ratio for a business that's not growing at all, but it has healthy balance sheet and strong kind of margins, would be in the range of about 15 to 25. Probably more on that higher end. Now, a business that's actually got really strong growth, we would expect this to be a lot higher. So depending on how much growth that is, you know, it could be above 30, above 60, some stocks are above 100, and depending on the growth rate, it may be that it's adequately priced. We don't just write stuff off because the PE ratio is way out. There's other ways to value businesses. All right, let's have a quick look at the balance sheet. I want to make sure while these guys were going a little bit backwards, that they aren't loaded up with a bunch of issues. So total assets is more than the total liabilities. We've got 900 versus 500 million. And what else? Total current liability. So long-term debt, it's only 29 mil. They got leases that they need to pay for. They've got non-current financing lease liabilities. All right. So you got some bits and pieces in there which they're going to need to pay for, obviously. But it doesn't look like there's any big red flags at this stage. Now let's have a look at the cash flow statement, because that money they get in doesn't necessarily pop out as cash that they can use in the future. Looks like there's a fair bit of a breakdown here, which is good for transparency. Just makes it a little bit trickier to go through this. And we've got 23, 24, 25. So net cash provided by operating activities, we've got 1 mil to 23 mil to 248. Ho, ho, ho. Yeah, boy. All right. There has been a few big changes in here. Nothing crazy, nothing that looks too out of the ordinary, like they're trying to bump the numbers up. Does look like generally there's bits and pieces coming out, and here's where we're at. Especially with that net income coming through. So we've got, this is always a lot lumpier than the net income, or not always, but majority of the time. So we expect there to be a fair bit of variation. We can even see back here, this business had net cash positive and from operating activities. So that's good. So to get our free cash flow, we've got talking about these acquisitions of property and equipment. And is there anything else that looks like it would be required? Nope. Pretty much just looks like you take that figure away. So this business is very low capital requirement. It doesn't need to invest a lot of its own money back into property, plant, and equipment, into its assets to be able to grow the business, which is pretty good. It means that they're a lot more nimble and they don't get that capital tied up where it is. It might be more based on, effectively relationship capital, managing its own team of people, etc., which you build up that with a great culture of the business. So there's other ways and different areas that they need to invest in, so to speak. All right, so that's pretty good. That means pretty much all that is cash. Now, where have they actually spent that money? Let's have a look. So that's investing areas, which is negligible. We've got financing activities. So you got some notes payable, lines of credit. That's pretty ordinary. We've got members distributions. So I don't know what that's going to be. I would need to look into that because it is a significant change for this year. Usually it might have dividends and things like that to shareholders and stuff. But we'll have to check out the notes in the financial statements when looking into this business for a deep dive to see what's going on there. What else can we see? Restricted cash. All right, so it does look like the majority of the money that they've got has just been kept as cash on hand. So they've ended that. You can see their cash position's gone from 40 mil up to 185. And so it doesn't even look like they've plowed it into they haven't even put it into like any kind of working capital. Literally just looks like it's sitting in cash and cash equivalents, I guess is what they're calling it. But sometimes I'll have it in, it'll be broken up into short-term investments, long-term investments, etc. That it's pretty much just notes and other things like that. But anyway, it's all sitting in cash equivalents, which is good. They're just, I guess, laying their foundation there for what they're going to do with it in the future, or if they're just trying to make their balance sheet a little bit healthier with the kind of trickier times that they're on. So is NUTX or NUTX, is it an interesting business to have a look into further? That's a hell yeah from me. It's obviously got some really strong revenue growth. You can't do a double and then a double and not be interested in that, at least to see what kind of growth prospects they've got and have a look at these reports to see what their strategy was for the growth and what they implemented for that. And so checking if management are doing what they say. The other part is it's cash flow positive and growing a lot. Majority of this net total revenue now, it's outpaced its costs, which is a challenge in itself, and its majority of that's getting converted into cash in the business. The business doesn't have to invest much in itself for growth, whether that be, going and advertising or working on its relationships with its hospital division, getting contracts. I have no idea. But at this stage, yes, we'll be looking into this business further. If you want to see some of the other small cap stock reviews, you can check out this playlist or check out this next video because YouTube thinks you'll like it. Cheers.